There are actually two types of stocks traded on the stock exchange: common stock and preferred stock. Most investors buy and sell common stock. Holders of common stock elect the board of directors and vote on corporate policies. Preferred stock refers to a class of ownership that has a higher claim on assets and earnings than does common stock. The main difference between preferred and common stock is that preferred stock gives no voting rights to shareholders while common stock does. Common stockholders are last in line when it comes to company assets, which means they will be paid out after creditors, bondholders, and preferred shareholders. How do you make money with stocks? This question was answered in a previous slide. The two ways you make money in a stock is through capital appreciation and dividends. Capital appreciation is also known as capital gains. This is when you buy a stock and later sell it at a higher price. The profit you keep is known as capital gains. Dividends is another way to make money with stocks. Some companies like to share a portion of their profits with their shareholders. When they do, this is called a dividend payout. The nice thing about dividends is that you get to keep the stock even though you are awarded a dividend payout. With dividend stocks, you can make money on the dividend and the capital appreciation. What is an initial public offering? When a private company decides it wants to go public, it will offer shares to the public in a process called initial public offering, or IPO. Companies do this as a great way to raise money and expand without having to borrow money in order to do so. The shares of the private company will be processed through an investment banker that will buy the shares and first sell those shares to private investors known as the primary market. This process is called pre-IPO. The remaining shares, if there are any, will be sold to the secondary market when the company officially offers its stock to the public. What is the market? When you hear people talk about the market being up or the market being down, they are specifically speaking about the Dow Jones Industrial Average, also known as the Dow. The Dow Jones is not the entire market, but an index made of the top 30 well-known companies. This index is a representative of the entire market and is a way that allows people to judge the trend of the overall market. There are other indexes, such as the S&P 500, which tracks the largest 500 companies, the NASDAQ, which tracks the technology companies, and the Russell 2000, which tracks 2,000 small cap companies. What is market capitalization? Market capitalization, commonly referred to as market cap, refers to how much a company is worth as determined by the number of outstanding shares multiplied by the current market price of one share. There are 6 classifications of market capitalization. Nano cap. These are companies valued at less than $50 million. Micro cap. Companies valued between $50 million and $300 million. Small cap. Companies valued at $300 million to $2 billion. Mid cap. Companies valued between $2 billion and $10 billion. Large cap. Companies valued between $10 billion and $200 billion. And mega cap. Companies valued over $2 billion. Mega and large cap stocks have usually been around for a while and provide a consistent increase in share value and dividend payments and provide the least risk. Small and mid cap stocks are in the process of expanding. They carry a higher risk than large cap stocks, but are attractive for their growth potential. Nano and micro cap stocks are small companies with the highest risk but largest gain potential. There are 2 types of financial markets that are described based on the trend of the market. There's the bull market and the bear market. A bull attacks by thrusting his horns up in the air. If the stock market trends up, it is considered a bull market. A bear attacks by swiping its paws downward. If the market trend is down, it is considered a bear market. How to evaluate a stock. As an investor, you will need to pick and evaluate stocks to determine if they are a good buy or not. The two ways stocks are evaluated is either by fundamental analysis or technical analysis. Fundamental analysis is the study of a company's financial statements. You will examine revenues, earnings, debt, profit margins, and other data to determine the financial health of a company. Long-term investors often cater their decisions based on fundamental data. Technical analysis is the discipline used by chart readers. Short-term day traders and swing traders will buy and sell stocks based on price trends and the pattern they see on charts. In this course, you will learn about both. It helps to understand both so that you can make a better informed decision on what stock to buy and when to buy it. Investors versus traders. In the previous slide, we talked about investors and traders. The way you buy and sell stocks will determine if you're an investor or a trader. Investors buy and sell stocks for long-term gains with a focus on value. Investors tend to lean more on fundamental analysis than they do technical analysis. Investors will hold stocks for 3 to 5 years or longer. Traders, on the other hand, buy and sell stocks for quick, short-term profits. Traders tend to lean more on technical analysis and are great at reading charts. Day traders buy and sell stocks during the same trading day. Swing traders buy and sell stocks for a day up to several months, but usually less than 1 year. Congratulations, you've made it through the stock market terminology training.